This presentation is all about where oil is heading in 2025, not just about the immediate concerns of the oil market, but some of the other events that are taking place around it. The first event that we should mention is the COP29 meeting, which is just underway in Azerbaijan. And the expectations for this current COP are pretty low because previous meetings have not really delivered what the COP meetings have promised. The main issue that is under discussion in Azerbaijan at this new COP is the question of finance for clean energy projects. And currently around the world, only about 15% of climate finance for clean energy is going to developing countries. And that is a problem because it's developing countries where the huge increase in energy demand consequent upon a big increase in GDP growth is expected. And unless the amount of finance that goes to developing countries is increased, there is no hope whatsoever of meeting climate change targets. So that's COP, and we'll have to wait and see what the outcome is. Now, as far as the other issue which surrounds the oil market, it's the question of peak demand. And it's quite fashionable at the moment to discuss this in terms of oil demand peaking around 2030 or possibly a little later. My own view on this is that peak oil demand will not be reached by 2030. And the main reason is very simple. Pent-up demand in developing countries remains very high. If you look at non-OECD countries, excluding China, which is a special case, you will find that this group of countries uses less than 3 barrels per capita per year. The OECD average is about 12. Now, I'm not suggesting that in the decades to come, these developing countries will use oil at the same rate as the OECD does, but to some extent there will be an increase in the per capita use from less than 3 towards the European average of around 8 or 9 over the next decades. And that would mean that the increase in production from these non-OECD countries will be greater than any reduction that we might see in the developed world. So the pressures for oil demand growth remain very high. That's in transport, for cars, for trucks, for ships, for aviation, and also in petrochemicals, which of course is important for plastics, which are found in almost every item that you can think of, including, of course, electric cars. Now, the short-term oil market, which is always very, very topical, and we have a meeting of the OPEC Plus producers at the beginning of December in Vienna to look at the oil market and to take decisions as to whether or not they should increase their production levels. And at the moment, based on data that is shown in a graph, it looks as if through 2025, supply of oil will exceed the demand for oil by quite a considerable margin, perhaps as much as 1 million barrels per day. And the problem that the OPEC Plus ministers have is that oil demand, while it's still growing about 1 million barrels a day per year, it's not growing by as much as was earlier expected. And on the other side of the balance, an increase in oil supply from non-OPEC plus countries is greater than the increase in oil demand. So you've got demand going up by about 1 million barrels a day. You have supply going up by about 1.5 million barrels a day. And the source of that 1.5 million barrel a day increase in non-OPEC plus supply is high production from various countries led by the United States, but also including Brazil and Canada, Guyana, Norway, and some smaller increases from other countries, including China and including Argentina. So the upward growth, the growth in non-OPEC supply is going to be pretty strong in 2025. And that means that the OPEC plus countries are faced with a very, very difficult decision. But although it's difficult in terms of it being painful, that they're not likely to be able to increase their production, the reality is that the OPEC plus countries, led by Saudi Arabia and Russia, are going to have to suck it up. It is a weak oil market that is not going to work in their favor. The fundamentals are so weak that they really cannot be overcome. And even if the OPEC plus countries were to increase their production to fight for market share, the resulting lower prices would not impact non-OPEC plus producers immediately, and would in fact probably upset Russia. Now, a theme in the oil market during most of 2024 is whether there is or is not a geopolitical premium for oil prices. And of course, this question arises from the Middle East situation arising from the October 7th, 2023 attacks on Israel, and of course the ongoing impact of the Russian invasion of Ukraine. But my own view throughout 2024 is that there has been very, very little risk to Middle Eastern oil and gas supplies resulting from the Israeli, Hamas, Hezbollah, Iran situation, simply because if there were to be significant interruption to supplies, the consequences are too dreadful, not least for the global economy, which would see significantly higher prices for oil and gas, because 20 million barrels a day of oil flows through the Strait of Hormuz. LNG supplies from Qatar, one of the world's biggest exporters, would also be impacted. Higher prices are bad for everybody. And as far as Iran is concerned, oil is its only significant export, and Iran's major client currently is China, which takes about 1 million barrels a day of Iranian oil and would not be very happy to see its supplies interrupted. So I have never thought that was a realistic possibility, and indeed more recently tensions do seem to have eased, and I think that we can now say that there is no geopolitical premium in the oil price. And in fact, we could see quite the reverse, because if the Trump administration carries out its promise to make a deal between Russia and Ukraine, that would probably lead to, if there is an agreement, to the removal of sanctions against Russia, which would allow Russia to once again compete for the European market and indeed elsewhere by supplying more oil and indeed more natural gas. So far from there being a geopolitical premium, if there ever really was one, in fact, geopolitics in the next few months could see lower tensions, which could mean more supply and, if anything, add to the downward pressure on prices that we already have. Now, one of the mantras that the Trump campaign was using during the recent election was the fact that if Mr. Trump comes to power again, there will be more license given to energy companies in the United States. And the phrase they used was drill, baby, drill. Now, the reality is, of course, very, very different, because even if the Trump administration were to open up more federal lands to exploration and development of oil, that would not happen to any significant extent during the next 4 years. And indeed, in any event, decisions about oil production in the United States are entirely in the hands of the companies who are investing in those projects. And of course, as time has gone by in the United States shale production industry, there is a greater concentration of ownership in the hands of the major companies, including, of course, ExxonMobil. And the decisions on production levels in the United States are not political decisions, they're commercial decisions. And companies will only raise their production if they believe there is going to be a market for that oil at prices which make commercial sense. So I wouldn't pay too much attention to the drill, baby, drill exhortation. The other issue which came up during the campaign was the reversal of a decision taken by the Biden administration to halt licenses to allow more United States LNG to be exported. It's almost certain that as soon as Trump comes in, that decision to halt the licensing procedure will be reversed, and in time, more United States LNG will be available to sell to Europe, or indeed to anybody else that wishes to buy it. But as we said a few moments ago, the possibility of there being a brokered deal to settle the Russia-Ukraine situation could mean that more Russian pipeline gas, and indeed more Russian LNG, flows to Europe and elsewhere than is currently possible under the sanctions regime. Therefore, the United States LNG exporters would find it more difficult to make sales into Europe and elsewhere than would otherwise have been the case. So although the United States will be able to export more LNG, it's not entirely clear that we'll be able to significantly export more to Europe. So in summary, there are a lot of issues around the energy markets and specifically the oil market at the moment, as is always the case. The big picture as far as the market is concerned is that it will be well supplied into 2025, and unless something changes, i.e. demand is stronger than currently expected, or the non-OPEC plus production growth is not as strong as expected, it is very, very difficult to see how oil prices can be sustained significantly above $70 a barrel. And indeed, the risk is far more likely that prices will be lower than that rather than higher. Thank you.